Artificial intelligence is the most valuable industry on Earth right now. Hundreds of billions of dollars have poured into it, and almost every single company building it is losing money on it. Not a little money. Enormous amounts of money every single day on purpose. This is not a scandal, and it is not incompetence. It is the structure of the business itself. And once you understand where the money actually goes, the entire industry starts to make a different kind of. Start with the thing everyone knows. Training a frontier model is expensive. You gather an enormous amount of text and images, you rent tens of thousands of specialized chips, and you run them continuously for weeks or months. The electricity bill alone for one of these runs can reach millions of dollars. The hardware costs far more. And at the end, you have one model. If a competitor releases something better a month later, that spending does not come back. But here is what most people get wrong. Training is the part everyone talks about, and it is not the part that actually bleeds money over time. The real cost is inference. Inference is what happens every time you actually use the thing. Every question you ask, every image you generate, every line of code it writes for you. Training happens once. Inference happens forever. Every day, for every user, for every request, on hardware that has to be powered and cooled and paid for. And this is where the business model runs into a wall. Most of these products are sold as a flat monthly subscription. You pay one fixed price, and then you use it as much as you want. Think about what that means. A casual user who asks 3 questions a month is enormously profitable. A power user running the model for hours every day, generating code and images and long documents, can cost far more than they pay. In most industries that averages out. In this one it does not, because the heaviest users are also the most enthusiastic ones, and they are exactly the people who sign up first and never leave. So the more successful the product becomes, the more money it can lose. Growth does not fix the problem. Growth is the problem. Now, why would anyone run a business like this on purpose? Because of what they believe comes next. The bet is simple. Whoever ends up with the most users, the most data, and the best model becomes infrastructure. Not a product people choose, but a layer everything else is built on. Companies have made this bet before and won. Cloud computing lost money for years before it became one of the most profitable businesses in the world. Search engines gave everything away for free until they owned the internet's front door. So the losses are not accidental. They are the entry fee for a position these companies believe will be worth far more later. The open question is how many of them are right, and how long investors will keep funding the ones who are wrong. Meanwhile, there is one part of this industry that is making extraordinary money, and it is not the part making chatbots. It is the companies selling the hardware. Every model from every lab, trained or run by anyone, needs chips, and a very small number of companies make the chips that matter. This is the oldest pattern in economic history. During a gold rush, the reliable fortune is rarely made by the people digging. It is made by whoever sells the shovels. The chip makers get paid whether or not any particular AI company survives. They are selling into a race where every competitor must keep buying, because falling behind is worse than overspending. The same is true one layer down. Data centers, power companies, cooling systems, networking equipment. All of it sells regardless of who wins the model race. So what actually happens from here? A few things are already visible if you know where to look. First, prices are quietly changing shape. Flat unlimited plans are giving way to usage limits, tiered pricing, and separate charges for the most expensive features. That is the market correcting an unsustainable model. Second, efficiency has become the real competition. Smaller models that run cheaply are improving faster than almost anyone expected, because there is enormous financial pressure to make them work. Third, consolidation. Not every lab burning hundreds of millions a year will still exist in a few years. Some will merge, some will be absorbed, and some will simply run out of patient investors. None of this means the technology fails. Railways were a financial catastrophe for most of the companies that built them, and the railways themselves were transformative and permanent. The infrastructure gets built, the technology reshapes everything, and most of the companies that funded it do not survive to collect the reward. So when you next see a headline about a record valuation or a staggering funding round, it helps to remember what those numbers actually describe. Not profit, not revenue, a bet on a position that does not exist yet. There is another cost that rarely makes headlines, and it is the people. A small number of researchers genuinely understand how to build these systems at the frontier, and they are compensated accordingly. Compensation packages in this field have reached levels normally reserved for professional athletes. A lab might spend more on 20 people than most companies spend on their entire workforce. And unlike hardware, you cannot buy talent once and depreciate it. You have to keep paying, and you have to keep paying more, because a competitor is always willing to pay slightly better. Then there is the data problem. The early models were trained largely on text scraped from the open internet, which was effectively free. That era is closing. Publishers, forums, and media companies noticed what their archives were worth and started charging for access or blocking it entirely. So a cost that used to be near zero is becoming a line item measured in hundreds of millions of dollars. And the highest quality data, the kind that actually improves a model, is exactly the data most likely to be owned by someone. Now add competition from a direction most people did not expect: free models. Several organizations release capable models publicly, at no cost, that anyone can download and run themselves. Some of these are backed by companies large enough that giving the technology away is a strategic weapon rather than charity. If a free model is good enough for most of what a customer needs, the price a paid model can charge collapses. You are no longer competing on quality alone. You are competing against zero. This is why so much of the industry has quietly shifted towards selling to businesses rather than individuals. Companies pay far more, they use the product more predictably, and they buy things a consumer never will. Security guarantees, support contracts, compliance, and control over where their data goes. A single enterprise agreement can be worth more than tens of thousands of individual subscriptions, and it does not churn the moment something newer appears. So the industry you see advertised, the friendly assistant for everyone, is increasingly a showcase. The business underneath it is being built somewhere much less visible. What does all of this mean for you practically? A few things worth keeping in mind. Expect the free and cheap tiers to keep getting more limited, not because anyone is being greedy, but because those tiers were always subsidized by investment money that will not last forever. Expect the best value to keep shifting towards smaller, faster models. The gap between an enormous frontier model and a small, efficient one is closing quickly for ordinary, everyday tasks. And expect consolidation to be visible within a few years. Some names that feel permanent right now will be acquired, absorbed, or quietly wound down. The losses are the strategy. Whether it works out is still, genuinely, an open question. If you found this useful, subscribe to Byte Brief for more of the reasoning behind the